Mm. Okay. Mm-mm. Okay, so the next topic I'm going to talk about is whole life. Okay, whole life policy. So we just got through talking about term life. And what did we say about term life? We said that in term life policies, as somebody gets older, the cost always goes up, right? But the way that they price them, let's say age 30 to 40 to 50 to 60, the way that they price them is nobody wants to pay a different thing every single year. So the way that they price them is they take the cost, let's say a 20-year term life policy. They take all the different costs for the different age based on the mortality table, and they somehow, some way, make some kind of flat payment for them so that they pay the same thing for the whole 20 years. So with the whole life, what they do is they actually do the same kind of calculation, except they go all the way to age 100. Okay? So then they make you pay like this. Okay? So that's why whole life is going to cost more than a term life. Just like a 30-year term costs more than a 20-year term, so, the premium is higher. So let's talk about, it's not supposed to go up and down like this. It should be a straight line. I'm trying to do this for the recording. I'm going to record this. So. Okay, so now let's talk about a couple things about whole life. There's a few things to know. Whole life is a very fixed type of product in its basic state. Okay, what does it mean? The premium is fixed. What is premium? What is premium?
Oh, the payment that you make.
Yes, the payment that you make is fixed. So is the cost fixed? The cost is not fixed. Okay? The cost, as I just said, always goes up as you get older. It doesn't matter what kind of insurance you buy. The cost goes up as you get older. Just because they fix the premium for you does not mean the cost is fixed. Okay, you understand? They take the amount of the cost and they do some mathematical averaging and they do some math and they give you a level premium, but it does not mean the cost is fixed. The cost is not fixed. Every year you get older, the cost goes up inside of the policy. You just don't see it. The premium that you pay is just the premium that you pay. All right? So what else is fixed? You see, when over all this time, nobody is giving a flat dollar amount and the money is just staying flat. Inflation is always happening, right? The cost of things go up just naturally in inflation. So what's going to happen is they also have to give you some interest to offset the money, right? So they give you a fixed interest also. So you see right here on this one is a term policy. This one is a whole life policy. So the premium is higher on whole life than the term. So what happens to all this extra money? Yes, because see, the cost for a 30-year-old is not how much they're taking from you. Do you see? You're paying way more than a 30-year-old mortality rate cost. You understand? So that's why, let's say you are 30 years old, you are 30 years old. I ask you, oh, how much are you paying for your insurance? You say, oh, I have a $100,000 policy, I'm paying $20. And then she says, what? How did you get that one? That's so cheap. I'm paying $50. You know, so some people just compare the premium, but they don't know, like, okay, well, his is going to expire and mine is forever. You know what I'm saying? So it's different. You know, that's why you can never compare insurance just based on how much you pay. It's not equal. So in this case, you have an apple and an orange. They're totally different products. So there's a lot of extra money that's being collected from the insurance company for the whole life versus the actual cost at that age. So what they do with that money, they put it into your cash value account. Okay, this is your cash value. All of this extra money here that they are collecting, this is going into your cash value. Okay? Now, can the cash value money just sit there and do nothing? No, they have to give you interest on it. So this is going to get some interest. So it's going to grow. The cash value is going to grow. One day, the premium that you are paying actually doesn't cover your cost because your cost is higher at your higher age. And so the premium, let's say you're paying $100 a month, for example. Right here, it might actually cost you $120 to be covered per month. So what do? So this is the hope is you build your cash value up enough that you get interest in there, and then this can help you to pay for the future higher costs. Okay? Now, in whole life policy, there's something else that they do. It endows at, let's just use age 100. Okay? It's not always age 100 because it started changing up some things. But let's just say this is how the basic whole life looks like. It endows at age 100. So what does that mean? Okay, let me. Yes.
It means it ends at age 100.
Okay, it ends at age 100. And then what happens?
You can get paid.
Paid how much?
Your face value.
Okay.
Plus.
Okay, so let's use the example of a $100,000 policy. Okay? This is the face amount. The face amount is the death benefit. Okay, the death benefit. So you are 30 years old, you buy this whole life policy, and it's for $100,000, and you got approved. And then the next day, something happens, you pass away, all right? So then your family's gonna get how much? $100,000, right? That's your death benefit. Now, 20 years later, you pass away instead of immediately. How much is your family gonna get? No, they're gonna get $100,000. Okay? Everything is fixed. Okay? So that's another thing about whole life. You're talking about a level, fixed, face amount. Everything in this thing, in this basic, pure structure of a whole life policy is fixed. Okay? There is no get your cash value plus your face amount. No, that's not how whole life works. Whole life, everything is fixed. So let me ask you this. If my premium is fixed, my interest that I'm getting on my cash value is also fixed, right? You already know my cost of insurance. Do you think they can do some computer projection and see what this thing is going to look like 50 years from now? Yes, because there's no variation, right? There's nothing changing. So everything is the same. It's just a matter of putting in a computer, and they can see 20 years later, 30 years later, 40 years later, how much is my cash value going to be? They can see it. It's a fact because everything is fixed. So whole life policies are designed to endow at age 100, which means by the age of 100, my cash value is going to equal $100,000. They're all designed like this. They're designed to endow at age 100, which means what? Your cash value is equal to your face amount by age 100. That's what it means. Endow means Your cash value equals what? Your face amount. So if you make it to 100 and you're not dead yet, you can just take the 100,000 because your cash value is equal to 100,000. Okay? That's how whole life works. And this is called a level death benefit. The death benefit works like this. So you have insurance and you have cash value. That's cash value. You have a $100,000 policy and you're building cash value. Now let's say over some time your cash value is growing, right? So let's say your cash value becomes $20,000 one day. Now when will your cash value become 100,000? At age 100. I'm just testing you because I just said it, right? Okay, so let's just say right now your cash value is 20,000. All right. Now you decide you need to use some of this money. So you call your insurance company and you say, you know what? I need to take $10,000. Can I get my money? What are they going to say? Yes, you can use it, but you're going to do it in a loan. You're going to borrow. That's how they use it in insurance terms. You're going to borrow $10,000 out of here. Okay? So now you take $10,000 out, and then something happens, you die. And you didn't put the $10,000 back. How much is your beneficiary going to get when you're gone? They're going to get 90 because this plus interest. Great. So they're going to get 100,000 minus your loan, minus the interest on your loan. Okay? Minus your loan, minus the interest on the loan. Minus the loan interest. Okay? So this just give you an idea. Because the death benefit is level. So if you take any of it. So now, some people say this. They say, okay, you mean to tell me if I have $20,000 and I die, my family still only get $100,000? What happens to my $20,000? What's the answer to that? It's a fixed death benefit, but what happened to my $20,000 is the question.
It stays with the company.
Okay, it stays with the company. Anybody else have another explanation? Okay, so you can look at it two ways. You can look at it as, oh, they kept your $20,000. Okay.
Because the person took it out of the loan.
I'm not talking about loans anymore. I'm done with that example. I'm talking about I have $20,000 and then I die and my family's getting $100,000 and they're wondering where my $20,000 went. Okay. So one explanation is the insurance company kept the $20,000 and now you beneficiary just going to get $100,000. That's one way to look at it. But the real way to look at it is the insurance company gave the beneficiary the $20,000 and added another $80,000 worth of insurance to give it to them. Technically, that's what's happening. Because remember, when you get to 100, your cash value is the same as this one, so they give it all to you. So actually, your $20,000 is part of the $100,000 face amount. So as you're building your cash value, you see, it's $100,000 fixed death benefit. So it's level death benefit, right? And this is your cash value. It grows over time. This is your cash value, right? So let's say this is 0. So this is my money. It grows. This is my cash value. When I get to 100, the cash value is the same as the 100,000. So the cash value is actually a part of that 100,000. So over time, I'm actually purchasing less and less and less insurance. When my cash value is $20,000, how much insurance do I really have? When I have $20,000 cash value, you have $80,000 insurance company money. Okay. When I have $50,000, I have how much insurance company money? $50,000 insurance company money. When I get up to $80,000 cash value, how much insurance company money at risk? Only $20,000 of their money is at risk. Does it make sense to you? This is called level death benefit. All whole life policies work like this. Okay? That is a basic structure of the whole life policy. Now, they might do other things to make it look different, but the basic structure of the whole life policy looks like this. Okay? It's fixed premium, fixed interest, it endows at age 100, and it's level fixed face amount. Now, what if somebody says, do I have to pay for this all the way to age 100?
Yes, you do.
Okay. In this scenario that I've given you, we're kind of talking about keeping the payment, because you see how I drew my line all the way to age 100? So this is someone who is going to continue to pay all the way to age 100. So if somebody pays all the way to age 100, we call it a straight life policy. Straight life. Some people even call it ordinary life. This means pay to 100. Now, some people have the concern. They say, you know what? I don't want to pay all the way to age 100. What if I'm become 70 years old? I'm not working anymore. You know, I'm not going to be able to pay because maybe all I'm going to get is my Social Security, and, you know, I have limited funds at that time. So then what do they do? You guys been reading chapter 2? What do they do? What happens if you have a 30-year mortgage, but you want to pay it off earlier? So what's going to happen to your premium? It's going to go up. You don't want to pay all the way to age 100? Okay, we can do something called limited pay. Limited pay. Limited pay whole life. Limited pay whole life means I don't want to pay all the way to age 100. I want to stop paying this thing earlier. Okay, so when do you want to stop paying? I only want to pay for 20 years and I don't want to pay anymore. Okay, then we're going to do a 20 pay life. 20 pay. 20 pay whole life means you're going to just pay for 20 years. What happens after 20 years? You don't have to make any more payments, and it's paid up. You're done paying. But what happens after 20 years and you die? You're going to get the 100,000. What happens if I get to age 100? You get the 100. Now, doesn't matter how long you pay, they all endow at age 100. Okay? They still all endow at age 100. It doesn't change your, your endowment period for the most part. It just changes your premium paying period. So let's say, for example, you say, well, I don't want to pay 20, or I can pay longer, but I just don't want to pay anymore after age 65. Then they call it pay up 65. They have all these different names if you look in your material. Huh? Is it confusing? It looks pretty simple. Oh, reading it by yourself. So limited pay policies are well suited for those who do not want to be paying premiums beyond a certain point of time. For example, an individual may need some protection after retirement, but he doesn't want to be paying retirement at that time, paying premiums at that time. A limited pay, they call paid up at 65 policy, means that, this is an option for him. Okay? Paid up at 65. I've even seen paid up 95 before. It means you don't pay to age 100, you pay to age 95, but you're still endowed. Okay? So now, if you want to pay it up in 20 years, it means what? If we use this example again, it means that this is 20 years, right? And you want to stop paying? Oh my God, you're going to pay a lot of money here in order to stop paying by this point. Because it has to have enough cash value here to get enough interest here to become $100,000 by age 100. All right? Any questions about whole life? Oh, they have one more option. Single pay. What is single pay? One time make a payment. Oh, you're going to pay a lot of money to single pay, right? It's going to be a big lump sum. Okay? Absolutely not. These aren't popular anymore. They're not popular anymore.
GoFundMe is popular.
GoFundMe. Okay. All right. So any questions about whole life that I can help you to understand? Okay, so what are some features about whole life again?
And that was like age 100.
So everything, just remember about whole life, everything is 6, 6, 6, 6. The only thing you can change is how long you want to make the payment. All right?